Welcome to the InterMarket Analysis video update. This video attempts to look not only inside the S&P 500, but we also look at other stock indexes as well as other markets outside of the stock market to get some insight as to what's happening within the S&P 500. This is being prepared for Monday, April 10th. This video will be a little bit different because of the holiday on Friday. The posting schedule for some of the blogs that we look at, as well as current market valuation, they updated a little bit later. I didn't have a chance to be able to include that in the weekly video update, so I'm including it in this update. So the first thing we'll look at are some latest charts from Isabel Net. This first chart just shows how global house prices are falling, and that is very recessionary. Not only inside the US, but globally this is occurring. The next chart shows the global earnings per share growth. It's on course for being down 10 to 15% on a year-over-year basis when we get to the second half of 2023. The light blue line shows a decline. That's put out by Bank of America, where the growth itself is measured by the darker blue line. Even though it's ticking up slightly, it's still negative overall. This chart just shows that gold, which has been in the news lately because it's starting to break out to the upside, there are a lot of speculators in the market right now. For a long time, gold really didn't do all that much, and now that it's starting to move up, we're seeing a real wave of folks getting back into that market. This looks at employment for the temporary help services, and this compares it to GDP. We're still declining overall. The red line are all employees, including temporary services, and that's starting to go negative, and that could pose some problems for the market. When we drop below this red line, that tends to be more recessionary in nature. This chart shows how weak the Purchasing Managers Index, or PMI, has been when compared to earnings, and that equals a negative payroll. The light blue line are the non-farm payrolls. That's still been staying pretty strong, even though it did decline in the latest report. The dark blue line is the ISM manufacturing, and that has really been declining. These two tend to move in the same general direction with each other. So will employment come down, or is the ISM manufacturing going to turn and go back up? This looks at weekly jobless claims. They did trail off in this post right here, where they're still quite low overall, suggesting that the employment situation remains strong. Then going over to Real Investment Advice, looking at their weekly newsletter, I have some text to also go through. It says, as we discussed over the last several weeks, the market continues to defy recession calls despite weakening economic data. That's what we're seeing. The economic reports coming out are weaker than expected, but the real test is yet to come. We're going to start going into earnings season, and even though the headline number, that's what the financial media likes to promote, it's their forward guidance that's really going to be paid attention to, and if they don't really give a good report, their stock is just going to be taken out and shot. Please also keep in mind that seasonally in April, coming up to earnings season, we tend to see a run-up, and then when companies report, we see a sell-off. Even if they did a lot better than expected, sometimes that can happen. Now, there are always exceptions to the rule, but typically this is what has happened in April. Another interesting point is that the banks will be the first companies to report their earnings, so that could be an interesting thing to keep an eye on. This chart on the bottom just shows the gradual decline in the earnings estimates over time. They've been going down, and this has been putting some pressure on stock prices. Nonetheless, looking at our daily and weekly charts, we're positive right now. Even after working off some of this overbought condition, things could change, and we'll be keeping a close eye on that to see if the environment shifts from positive, where it's at right now, over to negative if we do start to see declines. Then they go on to say the reverse repo shows that banks are really reluctant to lend. I'm going to step back a little bit and in very simplistic terms try to explain what the reverse repo is. They say here in their blog post, while the market has been trading more bullishly over the last few weeks, and that's what we're seeing in our charts, that rally is based on two primary hopes. The first is that the Fed is going to pivot pretty soon, and the second one is that this bank crisis is under control now. There's some quotes down here. It says Bank President Loretta Mester said on Tuesday that the U.S. Central Bank likely has more interest rate rises ahead amid signs the recent banking sector troubles have been contained. The only thing that you can compare that to is back in 2007, we saw something that was very similar when then chair of the Fed, Ben Bernanke, came out and said, we do not expect significant spillovers from the subprime mortgage market to the rest of the economy or to the financial system, and then everything fell apart after that. So the Fed is really dealing with some credibility right now. First, they said interest was transitory. Now it's more sticky. They're coming out and saying everything is just fine in the financial sectors generally and the banking sector more specifically, so a lot of people are not really trusting what they're saying right now. We look at this chart, overnight reverse repurchase operation shows just a massive climb, higher than it's ever been. And this is a program that the Fed has implemented. And part of the problem is also coming into this red line really shot up. This was during the COVID lockdowns when all of this liquidity was pushed into the U.S. economy. Well, now that's really starting to come out of the economy. And is that going to cause some problems? So what is reverse repo? There was a really good article this past week in the Wall Street Journal. They posted this diagram that you see down here. Simply, reverse repo is a program where the Fed sells securities to a firm with an agreement to repurchase them at a higher price the next day. The difference between the original and repurchase prices, hence the term reverse repurchase program, equates to the interest paid to the buyer. And banks use this to maintain liquidity, to earn a little bit of extra interest, and this is an important part of the banking system. Well, this is really kicked into high gear, and they're wondering if this is going to end up causing some kind of a problem in the banking sector. Also, it goes on to say a reverse repurchase occurs when a bank, money market, or Fannie Mae, Freddie Mac, those are mortgages, lend money to the Fed overnight in exchange for Treasury collateral. The investment is the only risk-free option for said entities. Other overnight investment options like Fed funds and repo have counterparty risks, meaning that the other side of the transaction may not always be able to come through. The Fed initiated the RRP program to help absorb the tremendous number of reserves pumped into the financial system when all of this stimulus came into the economy following the COVID pandemic economic shutdown. We can see the chart down below. The orange line just shows the average lending standard and how they've been going up lately. And we're also looking at things like auto loans, mortgages, small business loans, consumer credit, which doesn't count for credit cards, middle to large business loans, commercial real estate loans, credit card loans. All these things are bouncing around either up and down in this graph. We're wondering if things are going to start turning in one of these areas and bleed back over into the banking sector. We also look at this huge influx of money markets going out of banks into money market funds because a lot of smaller banks don't have money markets. You might have them with your broker or a larger bank. They're giving a lot higher rate of return, so people are taking their money out of savings and putting it into a money market account. Right after Silicon Valley Bank fell, the small banks saw a huge outflow of funds, thinking this is a small bank, it's riskier, we better get our money out of there. And the large banks saw a huge inflow of money coming into their banks, thinking that these banks are safer. This puts things in a really tough spot. There's a triple whammy placed on smaller banks because the flight of deposits to money markets to get higher yields, higher interest rates that they're also having to deal with, which reduces their collateral values because what they do is once they get a deposit, they take that money and go out and usually buy something in the treasury market. As interest rates are going up, the value of what they already own decreases, and this produces a real strain on the banks, and it also slows down economic growth, which rising interest rates, that's what it's supposed to do. They say that this time is a little bit different because money market funds, they're not really good at giving that money back to the banking system. They keep it within their own system. Then also they go on to say the Fed could ease this stress by changing the terms of the reverse repo facility. One way would be to cut the rate paid to money funds. There's a couple of quotes here that during the lockdowns, this was really one of the only ways that banks could make money. And money markets were really struggling during that time because interest rates were pretty much at zero. They couldn't even cover their operating costs, and this put a real stress on the financial system. So what the Fed had to do is they came in and pushed the overnight rate back down to the lower end of the federal funds target rate. Remember, they have a range whenever they raise interest rates. This would need to coincide with the Fed's raising This would need to coincide with higher rates on bank reserves, a move that would encourage money market funds to lend to banks rather than the Fed. Interest on reserves is currently at 4.9%. Then at the very bottom, they say, while the Fed is hopeful that the current drain on assets on smaller banks is inconsequential and contained, the same was thought about mortgages back in 2008. So this time things are different, but they're reassuring the public that the financial sector is stable. The hope for the demand for the reverse repo system will return to normal without consequence. This seems overly optimistic. I'm not any kind of an expert in this thing, but I'm mainly trying to get a handle on this from a perspective of how is that going to affect the stock market. We've been constantly worried about this idea. Is there more to come? This would suggest that we don't really know what's going to happen going forward, but we need to keep a close eye on things and not necessarily be surprised if we start hearing about other things in the news. Now, smaller banks may not get the press that some of the bigger banks do, so we may need to dig a little deeper to find out what's going on. Looking at current market valuation, we're currently fairly valued. We're not overextended to the upside based on their overall score. Here is their aggregate score. We're just below this +1 standard deviation. If we go above this yellow line, then we would be considered to be overvalued. And if the market keeps going up, that's likely to be what happens. Looking at the Buffett indicator, which compares stock prices with GDP, we're also below this +1 standard deviation, so we're considered fairly valued. The price earnings model is overvalued. We've gone above this +1 standard deviation, so that's a little overextended to the upside. The interest rate model is still fairly valued. Interest rates are still pretty low. Even though they're going up, they're still historically low. The mean reversion model, we're starting to get a little overextended. We're above this +1 standard deviation. This gray dashed line is the historic trend over time. If we're right on that line, we're fairly valued, where we're starting to break away from that. Looking at some recession indicators, the yield curve model, because we have so many yield curves that are inverted, that is very high right now that we will go into a recession. And the bond market continues to scream that now for a number of months. The state coincidence index model, as of the end of December, there are 16 states with decreasing SCI, indicating normal risk. This had been looking a little more dangerous as far as heading into a recession where we came above the +1 standard deviation, but since then we have dropped back down. If more than 25 states are seeing an SCI decline, that means that we're entering a recession. Then we look at market sentiment models. Margin debt is still neutral. When we were going down a lot in 2022, people were getting out of margin and not using that to purchase stocks. As we've been going back up, we're seeing that bounce up just a little bit. Our junk bond spread model remains neutral. It's still below the historic trend line. Now I'm going to go into the regular things that I cover in this video. The dashed red line on the top is a PE ratio of 20. That's price to earnings ratio. When we get above that line, we're considered to be expensive. When we go down to the blue line, we're fairly valued. When we get down to the green line, we're considered inexpensive or cheap. We remain above the red dashed line, and that's measured down below in this chart, showing that on a historical basis, we are expensive. Here's a chart going back to 1980 showing different major events that have happened and what the valuations were at that time. We also look at the Shiller PE ratio, which is coming in at 29.27. The median and mean for this indicator is between 16 and 17. Based on this raw number, we are still overextended, but the market doesn't use historical data to justify current prices. They look forward, and so we have forward PE ratios as well. These are earnings guidances and estimates of what analysts think will happen. As of Friday, the S&P is at 18.1, so we're below 20 but above 15. So the market is not considered expensive based on this. But we've been seeing some real back and forth concerning earnings estimates. A lot of analysts are overly optimistic going forward, where the reality is that earnings estimates keep getting lowered and lowered and lowered, and so there's a tug-of-war going on between the two. Looking at the mid-caps, we're right now at 13.2, so we're under 15, but still above 10. And the small caps, which have been getting hit hard lately, they're down at 12.7. Looking at growth versus value, we're still in an overall downtrend with growth, but showing some improvement, where value is still in an uptrend, but showing some real weakness as of late. When we compare the two, on top we have growth versus value, showing that it is underperforming but showing some improvement. Value versus growth down below is outperforming but is showing some recent weakness. Then we look at a number of different indexes and ETFs to look at the growth value ratio. We are bouncing back up, but we're still in an overall downtrend. This is an inverse of that same chart where value has been doing really well, but now starting to show some weakness. We look at some growth and value ETFs and compare them with each other, also showing us the same thing. Growth is in a downtrend, but showing some improvement. Here's an inverse of that same chart. Value has been in an uptrend, but showing some weakness. Then the last chart shows how growth has been underperforming value overall, but showing some improvement. Looking at some other markets, here we have the NYSE advanced decline line on top where it fell back down below its moving average. The S&P is holding up a little bit better. It's still above its moving average, where the mid caps have fallen below the moving average and small caps never got up to their moving average before falling back and are showing some weakness. Looking at the biggest software companies in the US, we've had a recent golden cross and they're showing some improvement. Looking at inflation, we have the CRB index, which is rolling over and actually on the weekly chart is giving us a downtrend. But what we look at on this chart is the inflation-deflation ratio. When we're below this moving average, that means inflation is going down and deflation is going up. We're also seeing this red line, which is a moving average, decline as well. So it shows that inflation is continuing to fall. Another way to look at inflation is the Baltic Dry Index, where it spiked up, it came up to its moving average, and is right at that level currently. We also look at the CRB by itself. This is a daily chart showing we had a recent death cross, and now we're in a downtrend. And then here are some different commodity prices that we look at just to keep tabs on them. Corn, as well as aluminum. Heating oil, which is falling but rising as of late. Gas, which is starting to go back up with the OPEC news coming out that OPEC is going to decrease their daily output of oil, and that's having an influence on oil prices as well as gas prices. Natural gas, after really spiking up, has come back down. We're down around $2. Oil did spike up this week on that OPEC news. We had been between 70 and 75. Well, now we've shot back up to 80. Diesel continues to decline overall. Wheat has also been declining lately. Fertilizer is stabilizing but has declined off much higher levels. Lumber is also in an overall downtrend. The dollar is also in a downtrend. The euro is in an uptrend compared to the US dollar, and the Japanese yen is also in an uptrend compared to the dollar. The British pound continues to be in an uptrend compared to the dollar. Here's a chart of the Japanese yen. We also look at copper. When copper is going up, that means that folks are looking more optimistic into the future. When copper is going down and gold is going up, that means that people are not as optimistic about things, and we'll look at gold later. But for right now, copper's been chopping sideways, but it's still in an overall uptrend. The copper to gold ratio, we keep a close eye on that. It ticked up a little bit, but it's still in an overall downtrend. Here's a longer term look at that same ratio. That's the black line where it's been falling as gold has been outperforming copper, or you could say copper's underperforming gold. We also compare that to the 2-year yield. Even though it's been falling, there's still a really wide spread between these two. Here's gold showing that it's in an uptrend overall, as is silver. Then looking at some other indexes, the CRB is underperforming the S&P. The next chart shows the S&P outperforming the CRB. This is a recent change that we saw between the NASDAQ 100 and the S&P 500. The NASDAQ 100 is starting to outperform the S&P 500. The red line on here is the S&P 500 equal weight, and that just treats all stocks inside the S&P the same, where the S&P 500 is a weighted index, so the bigger companies have more of an impact. We keep a close eye on this. When this is falling below what the S&P 500 is doing, that means that the really big stocks are doing better than all of the stocks in the S&P. So this is a little bit concerning, and what we're seeing in some other charts is that the real big companies are doing well, while the smaller companies are either not doing as good or actually down going back to the beginning of the year. The mega cap growth, the really big companies, we just saw a recent golden cross and they're doing better. Then we compare mega cap growth to the equal weight index. We're just about getting ready to see a golden cross in this ratio. The S&P 100 has been really outperforming the S&P 500 and just getting ready for a golden cross. Small caps continue to really underperform, and this ratio just disintegrates daily. Low volatility stocks are still in an overall uptrend and chopping around more or less sideways. That was the place to be in 2022. Doesn't mean that they didn't go down. It just often means that they go down less than some of the bigger name companies. And then comparing the low volatility ratio to the S&P, we've just seen a recent death cross with this ratio. The Dow Jones Composite, which takes the Dow, transports, and utilities together, remains in an overall uptrend. And looking at Dow theory, here's the Dow on top. We're seeing a bit of a negative divergence here where the Dow's been holding up better, but the transports have been seeing some weakness. We saw weakness in the utilities, but they're starting to come back, and they're matching up more with what the Dow is doing. Now, pure Dow theory just looks at the Dow and transports, where I also include utilities. Here's another way of looking at Dow theory, and I have another chart to show you. Because things have changed over the last few years, why not use the S&P 500 as the Dow? Because that's more of a representation of what's really going on. And then the smaller companies, that can be represented by the NASDAQ. And we look for either positive or negative divergences in this chart. Here's a post by David Keller, who's with StockCharts.com. He says that Charles Dow, who invented Dow theory and also the Dow Jones Industrial Average, he looked for confirmation between two indexes to confirm overall strength of the economy. The new theory uses the S&P 500 and the NASDAQ, and this would confirm to be bullish if the S&P 500 goes above 4170. We're not there yet, but we're not very far away either. And if the NASDAQ gets above 12,200. But if only one would break out, the dreadish bearish non-confirmation would be what we see. And here's a chart showing that, where things are holding up okay. The NASDAQ's been doing a lot better and could be breaking out. On the daily charts, I'm also watching this double top, and that's a bit of a concern. If we can break above that, that would be much more positive. The FANG stocks continue to be in an overall uptrend, where ARK is still in a downtrend, but we're chopping sideways. Give it some time and we might see a golden cross. Looking at the S&P 500 and then some international stocks, going out and looking in Europe, Australia, Asia, and the Far East, we're still in an overall uptrend. We're above this moving average, and that's positive. But you look down at the bottom, we have the PPO, which continues to decline, so that's negative. So we're getting a mixed picture. Looking at bonds versus stocks, bonds continue to be in an overall uptrend with the ETF. The Pring World Bond Index continues to be in an uptrend, even though it's been bouncing around quite a bit. The stock-to-bond ratio still shows that stocks are outperforming bonds, and shorter-term bonds are ticking up slightly, but pretty much going sideways when compared to the S&P 500. The high-yield corporate bond ETF is still in an overall uptrend, as is the investment-grade bond ETF. The stock-to-bond correlation, they're having a fairly strong tendency to go in the same direction. So if bond prices are up right now, stock prices might be up as well. Before that, we had been seeing them move in opposite directions. The Dow Jones Corporate Bond Index continues to be in an overall uptrend. The Treasury yield, after going way up, has been coming back down. Here's another look at the 10-year yield, which continues to fall. And here's another look at the 10-year yield. It's also falling down just above the 3.25% level. Here's the 30-year yield, which also continues to fall, where the S&P 500 is starting to show some improvement, but not enough to outperform bonds. Junk bonds continue in an overall uptrend, and our junk bond to government bond ratio shows that junk bonds continue to outperform bond prices, where they continue to go up. Overall, the MACD continues to be in an uptrend, and the RSI is above 50 and kind of going sideways currently. Here's a look at the 30-year down to the 3-month yields and how they've been behaving lately, generally going down overall. And here's a weekly chart showing the US, the UK, and Germany, how their rates have been coming down. Japan has been going back up a little bit, and their rates are quite a bit lower, but they have their own scenario that we're keeping an eye on. Looking at the S&P to the ICE, Bank of America High Yield Index, this is trying to measure risky against not as risky investments. When this is really going up, that means there's more risk. We're still below this moving average, but we are starting to go back up, and the moving average is continuing to advance, so we'll keep an eye on that one. Looking at the S&P against other sectors, in a good, solid market, we want to see the S&P really outperforming utilities, and that's just not happening right now. So that is a warning sign that I've been pointing out on the daily videos. The staple sector is still in an overall uptrend. And when you compare energy to the S&P, just about getting ready to see a death cross in this ratio. The tech sector is in an overall uptrend. The semiconductors are also in an uptrend. Comparing tech to the S&P, tech is really starting to outperform, and we've seen a recent golden cross in this ratio. Then we look at some other ratios. Discretionary has been doing pretty good, but it's starting to fall back as of late. Where the energy sector is showing some weakness, we're still in an overall uptrend compared to the S&P, but if we continue to fall, we might see a death cross in the near future. The materials are still in an overall uptrend. The financials, getting ready to see a death cross here because of this banking crisis. And real estate is in an overall downtrend compared to the S&P. The utilities are also in a downtrend but bounced back in this recent week. Healthcare is also in an overall downtrend. Here's the ratio to the S&P showing us a recent death cross. Communication is now back in an overall uptrend, and this is one of the leaders in the market currently. Staples also with the ratio giving us a recent death cross. Industrial still in an overall uptrend, but showing some weakness. Looking at the NASDAQ against the S&P 500, we're seeing a golden cross here with the NASDAQ starting to outperform the S&P 500. And the NASDAQ 100 is doing even better than that. It's really shooting up and is in an overall uptrend when compared to the rest of the NASDAQ. Growth, which are the buy low, sell high companies, and comparing them to government bonds, growth still is in an overall uptrend when compared to bonds, even though bonds have been doing a lot better. Energy, which had been really strong when compared to tech, is now starting to fall back, and we're seeing a death cross with this ratio. The tech sector has been underperforming the rise in interest rates, but we're seeing a golden cross here where tech is now starting to do better than the rise in interest rates. Discretionary is still in an overall downtrend when compared to staples, but showing some improvement, but also some weakness at the same time. Staples are still in an overall uptrend, but they've been falling back when you compare them to discretionary, but they're starting to bounce back up. Looking at gold against the S&P 500, gold is outperforming the S&P and in an overall uptrend, and gold is also in an uptrend when compared to the dollar. High leverage loans are still holding up fairly well, and they're in an overall uptrend. These are risky loans, and as I say in every video, if the economy was getting ready to fall apart, we would not see these continue to climb. Then looking at our intermarket analysis chart going back to the beginning of 2022, oil is in the lead. Gold is now recaptured above the dollar, where stocks and bonds are still negative. Looking at banks, here's the bank ETF in an overall downtrend. Here's one regional ETF of the banks showing that it's been building a base here, but really falling. Here's another regional banking ETF also declining. Here's a ratio between the regional banking ETF and the financial sector, where the regional banking ETF continues to underperform. And here's First Republic, which was in the news for a while. It's bouncing all over the place. Then we keep an eye on the yield curve. The 10-year to the 2-year and the 10-year to the 3-month are what we watch closest. They are both inverted. They're below these red lines. The 30 to the 5 is just barely going back to normal. The 10 to the 5 is coming back up, but still remains inverted. I don't follow this bottom line as much because the Fed funds rate is only updated about once a month. I do keep an eye on what's called the euro dollar futures, which doesn't mean that it's dollars in Europe. That's another proxy for the Fed funds rate. And if those start to get too crazy, I will show you those charts. Then we also look at cash as measured by the 1 to 3 month T-bills against the tech sector. When we were running into some trouble back in the great financial crisis, people were getting out of the tech stocks and getting into cash. And so we saw this black line really going up. Then things got a little bit better, so this ratio started to come down. From 2010 up to the beginning of 2022, this ratio had been declining, meaning that the tech sector was doing very well. Then we got into 2022. This spiked back up, and now we're starting to come back down. And this is also suggesting that for right now, people are favoring the tech sector over being just in cash. But we want to keep a close eye on this ratio. Looking at some other indexes, the microcaps, after setting a recent 52-week low, they're bouncing up a little bit. However, they still remain in a very dangerous-looking uptrend. We could be getting ready to see a death cross with this. And this feeds more into the small caps. If we're seeing micro cap problems and small cap problems, that could really put some pressure on the market. Here's the small cap index, still in an uptrend, but they came up to this pivot level and have been falling back down. Here's another look at the small caps based on the Russell 2000 index. We're below 50 with the RSI. We've been declining below the 50 and 200-day moving averages, but we're still in an overall uptrend with the MACD, even though it's beginning to roll over. And the small cap ratio to the S&P 500 has really been breaking down. The small caps for the Elder Impulse system remain negative. Then we look at mid caps, still below the 200 period moving average, but in an overall uptrend. And for the Elder Impulse system, the mid caps remain negative. The Dow is above its 50 period moving average and going sideways the last few days. The diamonds remain neutral. The NASDAQ gave us a recent golden cross, and this is that double top that we're watching at the 12,250 level. Can we break above that and then close above it? We came right up to that level before, and that acted as resistance, and we fell back down. If the NASDAQ continues to go up, we'll be seeing if it can get above 12,250 and then close above that. Here's a look at the Fibonacci retracement levels for the NASDAQ. We never got up to the 38.2% retracement. Here's another look at that double top that I'm keeping an eye on. The NASDAQ 100 is breaking out a little bit better. We do have some overhead resistance, but we are in an overall uptrend. And the Qs for the Elder Impulse system are neutral. Here's a look at the Fibonacci levels for the NASDAQ 100. We came up to the 38.2% retracement, fell back. Now we're starting to go back up higher. If we continue to fall, we'll be looking at this level as being potential support. The NYSE is in an overall uptrend, and the Wilshire also is in an uptrend. Looking broadly at the 5-period moving average of the highs minus the lows, we still remain negative overall. This is a bit of a warning sign. The market was really strong and being participated by all stocks. We would want to see this break above zero, and it's not doing that. All stocks still remain in an overall uptrend, and emerging markets are also in an uptrend. Internationally, China, emerging markets, Europe, Japan, and the US are all turning up and looking more positive. Bitcoin is also in an overall uptrend. Looking at some correlations, the S&P to the dollar, they're having a pretty strong tendency to go in opposite directions. So if the dollar's down, stocks will be up and vice versa. S&P to oil having a tendency to go in the same direction right now. And S&P to the 10-year yield also a slight tendency to go in opposite directions. And we're also seeing the tech sector going a bit in an opposite direction of the 10-year yield. And here's the S&P to the 2-year yield where we are neutral currently. And then looking at the home builders, this is another signal that was generated that was negative that we're keeping an eye on. As we were going down over the last few days with the S&P 500, the home builders ETF was also going down and the ratio was going down. But we saw a real divergence in their relationship with each other. A lot of times when we give an extreme reading, like it's marked right here by yellow, that often marks some real pressure for stocks. Now, it could improve, but before, this has marked some kind of a top in the S&P, so we're keeping a close eye on that. Looking at some longer-term charts, the NYSE is just a little bit below its monthly moving average and going sideways, where the Copic curve is trying to turn up a little bit, and that could be positive. The NYSE record high percent index based on the NYSE has been bouncing back up, saw some weakness, and then had a pretty good week this past week. The PPO compared to the S&P 500 is looking more positive, and comparing the S&P to the CRB index, the S&P is outperforming. Here's the S&P to the global index, where the KST is still negative, but we're still above this advancing moving average. A monthly chart of the S&P shows that the CRB is underperforming bonds. And this is an inverse of that, showing how bonds are outperforming the CRB. And another CRB on the top, which is rolling over a bit more. But the ratio shows that the CRB index is underperforming bonds. And we also have another index showing how bonds are outperforming the CRB index. And in the short term, we're turning more positive with this weekly ratio. Intermediate term, we're also positive. An update of a few of our charts, and I have something interesting here. We see the S&P 500, which is the large cap index. It's been showing some improvement. It bounced up and has then fallen back. But if we look at the mid caps, they're looking a little bit weaker. And if we look at the small caps, they're even a little bit weaker. So this is a concern overall. We're not seeing real broad participation in the market right now. So what is currently positive in the market? Nothing has changed if you watched last week's video. Value indexes and ETFs are positive. The big software companies, the euro, the Japanese yen, and the British pound, copper, gold, silver, the mega caps, low volatility stocks, the composite average, FANG index, bonds, all different levels, ETF, high yield, investment grade, world bonds, corporate bonds, and junk bonds. The staples are still positive, tech and the semis, high leverage loans. All of our indexes that we track are still positive, including the NASDAQ and NASDAQ 100, the NYSE, as well as the Wilshire, all stocks, which looks internationally as well as domestically, and emerging markets, as well as Bitcoin. Negative. We have the growth is still negative, even though it's been showing some improvement. The CRB index is in a downtrend, the dollar is in a downtrend, and ARK continues to be in a downtrend. Thank you. I hope you found this helpful. It's probably a little longer than usual because I had those extra charts to go over. I hope everybody has a really nice Easter, and I will talk to you in the next video.